If you're not learning, you're falling behind. Subscribe now. Welcome back, Focus Learners, to another explainer. Today, we're unpacking a document that, on the surface might seem kind of mundane, but I promise you it's anything but. We're looking at the absolute financial bedrock of any operating business, the purchase order. Now, we've got to establish right away that a PO is not just some corporate shopping list. It is literally the exact moment a legal commitment is born. It's the formal document confirming your intent as the buyer to purchase specific goods or services for an agreed-upon amount. If you skip this step or, just treat it lightly, you've lost financial control before you've even started.
Okay, let's dive into this. That quote right there, it perfectly captures the insanely high stakes of corporate purchasing. The purchase order is the silent guarantor of financial integrity for pretty much every company out there. It's the core control document, making sure you get exactly what you pay for, and crucially, that you only pay for what you actually get. Today we're going to look at the shortcut to understanding the why behind all the procurement chaos, not just the how of filling out some form.
To do that, we have to look at the entire procure-to-pay or P2P cycle. Think of the P2P cycle as our chronological roadmap. It's the journey taking us all the way from someone in a department saying, "Hey, I need this," to the accounting department finally saying, "All right, I paid for this." It's an end-to-end process meticulously designed to enforce real organizational checks and balances.
So here's our roadmap for today's explainer. We'll start with the blueprint of business, move into structuring your commitment, and then look at statuses and internal controls. After that, we'll tackle managing transit and risk, explore quality and dynamic pricing, and finally, lock the whole shebang down with the three-way match. It's a beautifully structured journey through the life cycle of corporate procurement, so let's get into it.
Section 1. The Blueprint of Business, laying the foundation for accountability.
Before a company can even declare what it wants to buy, it has to lock down the foundational details, right? The vendor account, the specific site identifier, like the campus, and the exact warehouse for accurate inventory counting. From there, the strategy kicks in. The system actually distinguishes between three primary types of purchase orders based on your intent. First up, the journal PO. This is basically just a draft used for internal planning. It doesn't affect your stock levels at all. Next, you've got the returned order, handling reverse logistics and tracking your eventual credit. But our main focus today? The standard PO. This is the one you use once the vendor has confirmed the order. It signals a real impending transaction and carries the heavy weight of a real legal commitment.
Moving on to Section 2, Structuring Your Commitment, Header versus Lines. Now that we know we're using a standard SOPO, how is this document actually structured to enforce discipline while still allowing for agility? Well, it's all about the split between the header view and the lines level. The header view dictates the global rules. It sets the vendor, the accounting date, the overall delivery date, and the project ID, so costs are allocated correctly right off the bat. But the lines level? That gives you flexibility. It specifies the granular details, the exact items and quantities. Let's say your header dictates a January 1st delivery for 50 servers, but oh no, a catastrophic failure means you need 5 of those servers right now. At the lines level, you can actually override the delivery date for just those 5 urgent servers, bumping them to December 15th, without messing up the logistics for the other 45. Pretty neat, right?
Section 3, Statuses and Internal Controls, the journey to a contract.
So all those granular details, they don't mean a thing without internal sign-offs. We track the approval status from draft to in review and finally approved. But that internal approval runs right alongside the logistical reality, which we track through the document status progression. It starts at none, then maybe purchase inquiry if you're just feeling things out with the vendor. But step 3 is the absolutely critical one, confirmed purchase order. You can't get here without internal approval, and once you do, boom. The confirmed status is the absolute point of no return. You are legally on the hook. From there, it flows to product receipt when the boxes actually show up, and finally to invoice when they ask for the money.
Now you might be wondering, what happens in a real emergency? Like what if a critical machine literally breaks down or the CFO is demanding a new laptop today? In a system built on strict controls, businesses use unplanned purchases as a necessary escape valve. But to prevent total chaos, this requires confirming PO codes. It lets authorized users skip the normal tedious multi-step process for a genuine emergency, acting as an emergency brake that still leaves a clear audit trail. Believe me, if management sees those codes being overused, it's a massive red flag.
All right, we've talked a ton about internal rules and structural discipline. But once that order leaves the vendor's facility, we enter the Wild West, the massive external complexities of global supply chains and liability. At this point, we have to ask the big question. Who actually carries the risk?
Section 4. Managing Transit and Risk. Delivery Terms and Incoterms. All of this external risk is managed in the Delivery tab, where you set tax implications, net 30 payment terms, and the absolute linchpin of logistics, Incoterms. Now, what's really interesting about this slide is how these three-letter acronyms define everything. They dictate who pays for transport, insurance, and crucially, when the risk transfers from seller to buyer. FOB means you take the risk once it's loaded. CIF means the seller holds the risk during transit. But look at EXW or XWorks. This is a massive buyer beware situation. The seller just leaves the items at their own facility. You could be legally liable for a multi-million-dollar shipment the second it leaves their loading dock, even if it crashes just 1 mile down the road from their factory. Crazy, right?
Section 5. Quality and Dynamic Pricing. Granular Tracking and Financial Fine Print.
Let's zoom back in from global freighters to the specific line details that fulfill that original purchase requisition. Buyers have highly granular logistical controls, like the stop toggle, direct drop delivery, or preventing partial deliveries. And that control extends deeply into inventory management. Look at the contrast between a lot ID and a license plate. The lot ID is an essential unique batch identifier tied to a production date, absolutely crucial if there's a product recall. The license plate, on the other hand, is the tracking ID for the physical pallet moving through the warehouse. Together, they show how inventory management goes far beyond just counting boxes. It ensures total traceability. This granular detail even allows for some pretty advanced dynamic pricing. Imagine ordering 1,000 liters of a chemical solvent that must be exactly 98% pure. With attribute-based pricing, the item's final price isn't totally fixed. If the purity test's lower upon delivery, the price dynamically drops. If it's higher, you might actually pay a premium. It links the PO line to the actual test result at the loading dock, ensuring you pay for the quality you actually got, not just the quantity you originally typed into the system. It's a real game changer. Just to set the stage for our final act, we need to briefly review these 4 financial markers for quantity. Open order means items are outstanding. Received means they arrived, but you haven't been billed yet. Invoiced means the vendor sent the bill. And canceled means no open quantities are left. We care about these statuses because they tell the finance department exactly where their liability currently stands. This perfectly sets up multi-line discounts and the final payment phase.
So, we've built the contract, we've managed the global risk, tested the quality, and counted the inventory, but now we face it, the most critical financial question in the entire process. Before a single cent leaves the company bank account, how do we prevent fraud?
Section 6. The three-way match. Receiving, invoicing, and payment. All right, we step into the warehouse phase. The physical goods have arrived. The receipts list is tallied, and warehouse staff post product receipts as full, registered, or received now quantities. So the crucial point is right here. Before any payment is authorized, accounts payable utilizes the ultimate defense, the three-way match shield. The system has to verify that 3 distinct documents perfectly align. Number 1, the purchase order, what you promised to buy. Number 2, the supplier invoice, what they say you owe. And number 3, the delivery receipt, what the warehouse confirms you actually received. Matching these 3 is the absolute non-negotiable step that stops double billing and outright fraud dead in its tracks.
Once that match is green, we follow the final accounting flow. On day 1, goods arrive, hitting a liability account called Accrued Purchases Received, not Invoiced. By day 5, the invoice is entered, creating a voucher that hits your expense or fixed asset accounts. On day 6, the liability balance carefully shifts to Accounts Payable Others. Finally, around day 30, the accounting team creates a VenPay journal. They pull up that approved 3-way matched invoice, simulate the posting to validate it, and with one final click to post, the funds officially move out of the bank account. And this brilliantly illustrates the immense power of the fine print. We've journeyed all the way from that initial "I need this" to locking down a legally binding standard PO. We've navigated the deliberate progression of internal statuses, external statuses, managing legal risk, and we've deployed the ultimate financial defense of the 3-way match. It's a system built entirely on granular accountability.
You know, in the world of the procure-to-pay cycle, the smallest acronym truly holds the biggest financial risk. Contrasting simple consumer shopping with massive global commerce, it's just a whole different ballgame. Choosing EXW instead of CIF can literally bankrupt a supply chain. Understanding this process is the difference between blindly ordering something and truly mastering a contract. So the next time your company clicks buy, you have to ask yourself, do you actually know who holds the risk? Thanks for watching, and I'll see you in the next explainer.